All right, and we are live. Everybody, welcome back. It is Thursday at 11 a.m. Central Time, Crypto Power Hour time, as some of you become kind of accustomed to at this point. Today, I do have a great guest as always, Andrew.
Hello, everyone.
And the topic for today, basically, we're going to break down because we got a little bit of crypto law news, and we're going to dive deep into the Digital Commodities Consumer Protection Act. A little bit of a mouthful. Yeah, I wanted to make sure that I got it exactly right, so I had to read it. But kind of want to dive into it. If anybody has any questions throughout the stream, go ahead and leave a comment on them. We'll try to get to them at the end as well. So let's kind of jump right into it. And Andrew, do you kind of want to summarize some of the key points to this bill?
Sure. So hello, everyone, and welcome to the Crypto Power Hour. And my name is Andrew Gordon. I'm an attorney and CPA, but by way of disclaimer, this is not legal advice. So any of the concepts that we're going to be talking about today, which might be legal or tax in nature, you should always consult a tax professional first. That said, there are a lot of new interesting developments that are happening in the world of crypto. And so one of the things that we want to do in this group is to inform all of you of the different legislative efforts and different things that you might even want to get involved in to further support crypto. And it's been a very exciting time, especially in the last year. More than ever, the U.S. government has been paying attention to crypto. President Biden issued an executive order several months ago, I think back in January, that identified a number of different priorities of the federal government to become more informed about crypto and also to use it where possible as well. And so there's been just more and more attention towards crypto as a result, not only of this executive order, but also just in the marketplace overall. Sure, we're in a bear market now, but for much of the last couple of years, crypto prices were increasing. Adoption was increasing. I mean, we've seen so many stadiums now that have even been named by crypto companies. So it's crypto is becoming a much more prevalent part of everyday life. And so now we see Congress has been stepping up to the plate and trying to have new legislation with the intent to better regulate through legislation that makes sense and will hopefully resolve some of the issues that exist today. Because many people will tell you that crypto is kind of the Wild West when it comes to regulation. And I don't think that that's necessarily true. I think there is a lot of regulation that is out there, yet at the same time, there certainly is not enough. And I know many of you are thinking, well, any regulation is bad regulation, and that isn't necessarily the case either. I think as long as the regulation makes sense and it helps clarify things, it will help boost the crypto economy overall. And so the Senate, especially, there have been recently some bills to try towards that path to better regulate and provide clarity with respect to what exactly is crypto and who is in charge of it. And so a few months ago, there's the Gillibrand and Loomis bill, which I'll quickly highlight some of the different parts of that bill. But what we're talking about today is a more recent bill, which is the Digital Commodities Consumer Protection Act, which was introduced to the Senate floor on August 3rd by Senators Stabenow and Boozman. And it has not been voted on. It's only been introduced. But a few months ago, there was the Gillibrand and Loomis bill, which also had been introduced to the Senate, but not yet voted on. And to remind all of you out there, if you had not watched our prior Crypto Power Hour about the Gillibrand-Loomis bill, some of the highlights of that bill were that if you had capital gains under $200, for instance, on the purchase of a good, that wouldn't be taxable, which is pretty huge. Now, for instance, if you use crypto to buy a cup of coffee, that's a taxable event. And so under the Gillibrand-Loomis bill, that wouldn't be as long as it's under $200. So that's pretty big. Also, another big one for mining and staking, those rewards would not be taxable until they're eventually sold. That is a hot area of debate. And right now, the guidance is pretty clear that staking and mining is taxable as income. But there have been efforts to try to change that so that it's only taxed when you sell. And with Ethereum, for instance, we're going to have the Ethereum 2 merge soon. And perhaps more and more people are going to get involved in proof of stake. And so to be able to defer taxes until sale would be quite huge for that industry. So that was the second part of the Gillibrand-Loomis bill. And the third, which is going to be related to the Digital Commodities Consumer Protection Act that we're going to talk about today, is that the prior bill would have most crypto regulated by the CFTC rather than the SEC. And that also would be a pretty large shift because nowadays, most of the enforcement action by the federal government in the crypto space is by the SEC. And this would move crypto to be instead under the enforcement authority of the CFTC. So let's talk a little bit about why we're here today, the Digital Commodities Consumer Protection Act. And yes, every time I say it, I have to look at the screen because it is a mouthful and it's almost like a tongue twister. But the DCCPA, which was, again, introduced only recently on August 3rd, the big component of it would be to have crypto, again, not be under the enforcement umbrella of the SEC, but now under the CFTC, which is an existing regulatory agency, the Commodities and Futures Trading Commission, which would then regulate crypto. That's one of the largest parts of this new bill. The other is to protect consumers and to require digital commodity platforms to do such things as eliminating and prohibiting abusive trading practices, disclosing conflicts of interest, maintaining sufficient financial resources, cybersecurity programs, and protecting customer assets. And even recently, we've seen with certain platforms that they've fallen into some of these issues. There have been lawsuits against platforms for insider trading by employees. We've recently seen the collapse and bankruptcy of platforms like Celsius and Voyager for not holding sufficient reserves. And so a big part of this legislation would be to try to protect consumers from these things and require platforms such as Celsius or Voyager to meet certain requirements and to follow these rules. The last element of the DCCPA that I want to mention is also advertisements. I mentioned at the beginning of the Crypto Power Hour a few minutes ago that we see crypto everywhere, including on stadiums. During the Super Bowl, I think more commercials were for crypto than any other single industry. And so it is front and center. And in fact, even the Coinbase ad during the Super Bowl was nothing but a QR code. And so the DCCPA would require these platforms to meet certain advertising standards, disclose information about the digital commodities in general and their risks, and in general overall have greater accountability and transparency in their advertisements. So these are several different areas that the DCCPA would cover.
Yeah, Andrew, and I know if anybody is listening out there, they might be like, okay, we've heard Digital Commodities Consumer Protection Act so many times, you know, what's it got to do with me? This is a big deal, especially if you're in the crypto community. One of the biggest things for any type of tips or anything is to be following along with news and updates about everything. Now, we talked about, because you said it a few times, the CFTC would get regulation. Right now, crypto is under the regulation of the SEC. So, do you want to kind of explain a little bit the history with crypto and the SEC?
Sure. So, what is crypto in the eyes of the IRS? Is it a security? Is it a commodity? Is it a currency? There hasn't been much guidance, but what we do know is it's not generally considered as a currency. So we could scratch that off. And then what we've seen over the last several years is because there is no explicit laws on the books. Instead, the courts, through common law, through enforcement actions, are starting to show the public, well, what is allowable, what is not, what types of things will get these crypto projects in trouble. And over the years, the SEC has been the big bad wolf in the room. And the SEC overall has authority over securities. And what makes something a security? That's been the big question. And as of now, we look to a test that was identified years ago, decades ago, well before crypto was even an idea by Satoshi Nakamoto. It was actually decades ago that the Howey test, which is what we use, was created. And the Howey test generally looks at whether someone is making an investment with the expectation of profits as a result of the efforts of a third party. And that's kind of paraphrasing the rule, but it has been the application of the Howey test that has allowed the SEC to say, well, many of these projects are securities, and as a result, they have to register with the SEC, they have to meet all these requirements, and if you don't, and many don't, then we're potentially going to file a lawsuit against you. And so this legislation would instead say, no, most crypto is not or are not securities. Instead, they're commodities. And the enforcement of the CFTC is generally looser than the SEC. And once things are considered commodities, most practitioners and attorneys are of the belief that there will be less enforcement overall. That said, there may still be tokens that act like securities, or that people do ICOs, and that investment raise may still qualify it to be a security. So it'll still kind of depend. But overall, the hope is that by putting it under the CFTC, first we'll have more clarity on what exactly defines a commodity versus a security, but that also we'll see less enforcement going after projects, especially where the guidance is uncertain. And today, we're still seeing the Ripple case unfold. And most recently with the Ripple case, there's been a lot of back and forth with the court about what information Ripple needs to turn over. What information the SEC needs to turn over about what was going on behind the scenes and how they were determining whether something was a security or not. Because we really still don't know. We just have the Howey test. So it would be a pretty significant change to move this over to the CFTC.
Yeah, and the SEC's kind of been having this long crusade with crypto. I know you mentioned Ripple, which is still going on, but I know BlockFi was like a big one. They ended up paying like $100 million in penalties. Block One was like 24 million in penalties, and Cake was like 5 million in penalties. So there's this kind of relationship with the SEC and crypto kind of going on right now. But I want to backtrack a little bit. Can you explain exactly what the difference is between the security and a commodity?
Sure. So the best way to explain a commodity is even just using some examples. Resources, things like oil, corn, wheat, are typically commodities. And whereas investment contracts or assets, things like stocks, would be a security that would fall under the SEC. And so considering crypto more akin to something like wheat or oil, yes, there are regulations, but now we also know the different types of constructs that we can use with crypto. Now that we're saying that it's a commodity, well, there are trading floors specifically for commodities. And as long as you meet certain requirements, then you can trade commodities. And those are generally a little bit lighter than some of the requirements with the SEC. But from a tax perspective, there are also some very significant differences in how commodities are taxed versus other assets, things like stocks, or how crypto has typically been taxed. So with commodities, they're not just taxed at long-term or short-term when you sell it. First, there's generally an ability to use a mark-to-market election, which allows you to pay tax on the appreciated value over the course of the year. So you look at the price at the beginning of the year and then the price at the end of the year, and then whatever that value has increased, that's what you pay tax on, not your sales or your gains, but your overall portfolio. It's quote unquote mark to market, and you'll pay tax on that value. So that's one of the big differences. The other is that there would be a 60-40 split with long-term and short-term gains with a commodity. So with a security or a property or an asset, stock, crypto in general, they're typically taxed on a long-term or short-term basis. If you hold it for longer than a year, then it's taxed long-term, and those tax rates are more favorable. Long-term tax rates are 0 to 20%, with most people paying 15% tax rate, whereas short-term capital gains are your ordinary tax rate, and that depends on your overall income, and that varies from 0 to 37%. So in some cases, double the long-term tax rates. Well, with commodities, it is both short and long-term. It's split 60-40. And that may be good if you're a short-term trader, if you're continually trading and flipping. Well, then you're getting some long-term treatment, even though it wasn't technically long-term. But if you're a holder and you're typically receiving long-term capital gains, then commodities are not an ideal treatment from a tax perspective, because automatically part of it is going to be considered short-term. So if, and it's a big if the IRS follows these same rules and taxes crypto as commodities, then it would have significant changes. But the IRS doesn't always meet the exact same definitions as the SEC or the CFTC. And I'm uncertain if this bill had any explicit orders towards the IRS and how they're going to treat the treatment of crypto as a commodity or not. But typically, the IRS can kind of decide, is this going to be treated like property, a security, crypto? But if it is followed with the same consistent application, then I would expect a big difference in tax treatment.
And I want to throw one thing at you, one question that I'm very curious about. I'm a little bit curious about ICOs. So pretty much they're regulated right now by the SEC, and it's pretty much to protect investors. If crypto was considered a commodity, where would kind of ICOs kind of stand?
So the ICOs had a number of different issues, and they still do today. And in part, it was just how the ICOs are offered, that they're offered to the public, typically without any disclaimers or warnings. And so depending on how the token is sold, you may still fall under the enforcement lens of the SEC. That said, we're all crossing our fingers that, well, if the CFTC does take over enforcement, that there will be more guidance and clarity on, well, here's how you can offer a new commodity for sale legally, because we're talking about new tokens, right? If it's something that's being resold, then we shouldn't have an issue. But where the SEC may still become involved if a bill like this passes is on that initial sale of those tokens. How they're first released to the public, how they're advertised, whether or not there are any restrictions on who can purchase them. And candidly, this isn't necessarily a bad thing. I think we've all seen many ICOs over the years that advertise incredible claims, things that we just know are unrealistic, or perhaps they have certain yields, but they're just based on improper promises. So I think having still some enforcement by the SEC when it comes to these types of offerings isn't necessarily a bad thing, but that the secondary sales, especially once we have clarity on whether they're a commodity or not, that'll make things easier.
It's a great answer, Andrew. I didn't mean to throw you a curveball or anything
No
there.
worries at all.
But yeah, pretty much we've covered everything that we need to cover for specifically this act. And I really want to kind of get your thoughts and opinions. What does this mean for the future of crypto? Are we going to see more of these bills kind of coming up and maybe going nowhere? Could one possibly pass?
Yeah, well, I think it's a good thing overall that we're seeing more attention by Congress in these areas, and they seem to be thoughtful, right? This isn't legislation to kill crypto or increase enforcement. Yes, one could say, well, if we're requiring platforms to have certain reserves or meet certain standards, that this is enforcement or regulation. But these seem to be thoughtful and good things, right? Celsius likely should have been holding reserves of a certain amount, and there should have been greater transparency. And certain advertisements should have certain standards. So, I think the Senate and Congress are trying to act to protect consumers, create some more clarity overall for the industry, but that these are all good things, and that the fact that we're seeing, even in the span of the last year, at least a couple bills be introduced in the Senate on these points is a step in the right direction. And hopefully, even if these bills don't pass, there will be a bill in short time that does, or that these bills will start to consolidate. We're already starting to see common threads. For instance, that the SEC may not be the best body to enforce crypto. Instead, now we see two bills that suggest the CFTC is the more appropriate enforcement body. And so hopefully we'll continue to see more bills or one of these be passed. The Gillibrand-Loomis bill did have a few, I guess what I'd call moonshots. For instance, not having crypto under $200 taxed. That would be awesome for adoption. But how likely is that to pass? That's a tough one. At the same time, having staking rewards not taxed until sold, that would be awesome. I think, as I mentioned before, for even just Ethereum and proof of stake, but mining overall, it would give a large boost to that industry. In many ways, it would provide a greater benefit to those industries than other industries. And many people look to, for example, fishing and farming and those businesses that aren't taxed until they're sold. Well, Congress, in many of those instances, has intervened and passed legislation and subsidies to boost these industries. And that's kind of what we'd see with the Gillibrand-Loomis bill, that, hey, if we're going to give this more favorable treatment, it's the government saying, we recognize that this is an important industry. It's crucial towards the advancement of the United States, and the growth of these industries can be boosted by wise congressional intervention. And hopefully that's what we're starting to see.
All right, it does look like I have a few comments here. There we go. Nothing better than starting my morning with a coffee and great information from my favorite attorney. That's
I'm
what we
not
like
sure
to
who
see.
said that, but I didn't pay them. But thank you very much.
And then I have one more that says, I'd rather pay capital gains tax than mark to market.
And I think that that's a great point. Mark to market sounds good. Well, it will make record keeping a lot easier. One of the big difficulties with being a crypto trader is tax reporting and compliance. And I know all of you hate to even think about that, but it is a big issue for a lot of people, is just how do you report everything properly? And mark to market in many ways provides a shortcut, because all you're looking at is price at the beginning of the year, price at the end. But at the same time, if you're in an appreciating market and you're using tax planning, then mark to market is just going to give you a big phantom tax on cash or gains that you haven't even received, but just your portfolio value increasing. So great point to whoever left that comment, that, yeah, in most cases, paying capital gains is wiser than just using mark to market.
All right, Andrew, I want to thank you for your time today. I enjoy having you on and everything. I really appreciate it. Oh, Maybe one more. That's good, guys. Keep the questions coming. How do you report everything properly? Some experts handle it.
Well, I guess they answered the question for us. Yeah, tax reporting is very difficult when it comes to crypto. And I guess just quickly on that point, in 2023, crypto exchanges are required to start issuing more details than ever to the IRS and the Department of Treasury on the trading activity of their users. And so we're expecting more and more IRS enforcement audits because this information is being shared. On the other hand, we've seen over the last few years that the information that's typically been shared with the IRS is incredibly misleading. You can search for us on YouTube and you'll find some videos that talk about some of the success stories of where clients have received, for instance, notices saying they owe $700,000 because the IRS didn't know how to parse the data from Coinbase. And in reality, after we went through it, they only owed $3. So there are efforts, which is similar to the topics that we talked about today, in Congress, Department of Treasury, to increase the reporting. The goal would be to make it easier for taxpayers to report. But from what we've seen, just the opposite is likely to happen, that it's going to just add more confusion and issues.
All right, so I am going to wrap things up here. I don't think there's any last minute comments, but if you do have any comments, you can put them on the video in the description. We can get to them as soon as we can. Andrew, again, I'd like to thank you. I'd like to thank everybody who is watching. If you want to kind of stay up to date with crypto news and everything, go ahead and go to our website, gordonlawltd.com. If you go to the blog tab, we have great blogs that will keep you up to date with everything, tax law, crypto law, business law, whatever you need help with. I know we have it on there. I think that concludes it for this week's episode of Crypto Power Hour. Make sure to tune in next week. It is going to be a good show. I'm not going to try to give away too many details, but I can say it will be worth your while. Again, thank you everybody who watched, and we will see you next week.
Thank you, Jacob.